Welcome to the webinar, the CFO webinar today. And this is one of a series of many webinars that Sapphire Ventures sponsors as part of our Center of Excellence programming. And this programming is focused on providing the best practices content for various C-level leaders across high growth enterprise companies. And it's great to focus today on CFOs. And we have three great CFOs here today who've been through IPOs, M&A, and so much more, and they're going to lead us through that. But before that, I'm going to spend 2 or 3 minutes introducing myself and the firm. I'm Steve Abbott. I've been a partner at Sapphire now for 7 years, and among other responsibilities that I have, in addition to investment and board level responsibilities, I am our capital markets partner with about half of my time. What does that mean? That means that I'm focused on our Center of Excellence for capital markets for CFOs. I do a little bit of work internally, and the internal CFO work, if you will, or the capital markets work is managing our co-investors, focusing on our own capital markets strategy, for example, liquidating our public stocks when we receive them. But I spend more of my time working with our portfolio companies. We have over 60 direct portfolio companies now, and those CFOs have a lot of questions and a lot of needs around M&A discussions, IPO planning, venture debt raising, thinking about milestones for the next rounds. And so that's how I fit in with our work here at Sapphire. So if you think about, we titled the webinar Exit Planning, but planning is kind of an interesting concept, and we all definitely need a plan. If you don't have a destination, then I don't think you really know where you're going. But here at Sapphire, we would encourage you to think of the destination as building the best company you can. Think of it as building a company of consequence. That's what we call it here at Sapphire. Companies that are run by passionate entrepreneurs and are making a difference, doing things 10x better than the next guy, or solving an important problem for society. Build that company of consequence, and in our view, the exit will become a derivative of that. So you definitely, it's not ever really about exit planning until the exit is at hand, and then of course it is about exit planning, but really just build the best company you can. And as I mentioned up front, we have some real experts here who are going to talk through their own life stories and case studies. But a few concepts that I wanted to highlight in our experience at Sapphire about being a CFO, and that you can incorporate into your own personal OKRs, if you will, is that these concepts will work for you, whether it's an IPO or an M&A or just honestly just running your company. But you want to have the right, of course, audit and accounting systems in place that are going to work for an IPO. And why is that? You want those in place because if an IPO window opens up, you want to be able to jump through it. That's the first thing. Or the second thing would be, you want a credible alternative to M&A if you're thinking about going public. And the fact that you don't have to be at the door of an IPO, but the fact that you're pointing toward an IPO a year or two from now, and you've got the right systems and procedures for that, is going to be an important negotiating leverage point. You also want to know how to be an active CFO who's tied in with the sales function, with the product and planning functions, because you want to be like the wizard behind the curtain, making sure the company can meet plan and can beat plan, and doing that can drive incredible equity value. The third thing would be, the markets are more metrics driven than ever. And so it's like speaking a foreign language, speaking the language of SaaS metrics and speaking the language of unit economics. If you can speak that language to Wall Street and to potential buyers and translate what your company does into that language, you're going to ultimately create more value for your company. And then lastly, those pesky bankers. I was a banker for many years, so I know all about them. In fact, back when I was a banker, was dealing with Jacob. He's taken many companies public, so it's great to see him on the other side when I'm in the venture business. But there's 20 or 30 credible firms out there. You don't need to necessarily engage with all of them, or you shouldn't engage with all of them, but you should engage with some of the good ones by meeting with some of the right boutiques, some of the best brands in advance. You can evangelize your story out there. You can get good feedback on your story, and that can drive value. Just you have to make sure they can be a time sink, and you don't want to dive too deeply into that. So then lastly, I'm going to hand it over to Rob in a minute, but I wanted to remind you that we have an hour here today. I've taken up 5 minutes. Rob is going to take the next 35 minutes, and then we're going to have about 15 minutes for Q&A. We want to have this be pretty interactive. So if you have questions during it, you might want to take a look down at the bottom of your screen. You should have, in this webinar format, you should have a Q&A button. You probably also have a chat button, I'm not sure, but if you have both, that's fine. Focus on the Q&A button. That will put messages into the queue that Rob can see, and he'll end up ultimately directing those questions to the panelists during the Q&A. And then lastly, handing it off to Rob. For those of you who don't know Rob, I have his bio here. I've tried to condense it. It's pretty impressive. Says he's now a partner at Burst Capital on the venture side, but before that, Rob was the CFO of Yelp for 5 years, including during its IPO. So I'm sure he has lots of great war stories to tell from that experience. He also worked in a ton of other public and private CFO roles. He was at eBay, at shopping.com, at Move, and at Digital Think. He's on 2 public boards and 1 private nonprofit board now, and he's a finance fellow at the Aspen Institute, and I think most interestingly, teaches a course in his spare time entitled How to Be a Great CFO, which seems like an obvious course that every good MBA program should have, but I'm guessing that none of them do. The thing I know Rob most from is his tireless work on behalf of CFOs as a community. He's very giving of his time, and he runs a CFO network and a CFO forum. He has monthly emails you can probably get hooked into that have some great advice about topical topics for being a CFO in today's crazy market. So Rob, I'm going to stop my screen share, and the Zoom room is yours.
Well, great. Well, thanks, Steve. I appreciate that. And thanks for the intro. I'm happy to be here. And I'm happy to be here with some veterans to talk us through the IPO versus M&A path. Let me introduce Jacob. So Jacob is the CFO of JFROG, the creator of DevOps platform, which successfully completed its IPO in September 2020. So congrats on that. Yay. Previously, Jacob served as CFO of, and I'm going to butcher some of these names, so sorry, Jacob, but Mellanox Technologies, where he spent 11 years of growing and scaling the company from $50 million in revenue to $1 billion. He also worked in senior financial roles at Atrica, ThyssenKrupp, and Matad. So hopefully I got those right, but
yes,
you can look at his LinkedIn profile and see it for yourself. I'm also excited to introduce Sandy. Sandy is actually a graduate of the Rob Krolik CFO, How to Be a Great CFO course. Sandy is the CFO of Segment, a 500-person customer data platform recently acquired by Twilio in November 2020. So now we have the opposite path, or another path that you can take. She joined Segment in the fall of 2018, and she previously was a VP of Finance at Twilio for 5 years and helped guide them through their 2016 IPO. So I'm guessing that there's some nice connection there between Segment and Twilio prior to the M&A. And before Twilio, Sandy spent 10 years at Akamai Technologies in a range of finance roles, from investor relations to divisional CFO. before moving into the West Coast with Akamai. Sandy was corporate attorney in Boston. So we also have a lawyer on the show. I did see a quick question about share the slides later. I know the session's being recorded, so you can maybe view it later and pick up the slides, but I'll have Steve answer that later. So let's get kicked off here with these guys. Let's start with Sandy. So you got to the segment in October of 2018, and what I'd be curious about is what were the top 2 or 3 things that you identified that needed the most attention? And this is a couple years before being acquired.
Yeah, definitely. Segment had so many great, strong things going for it. But one of the things they didn't quite yet have was FP&A. There was sort of the classic kind of one man standing, doing everything, standing on a ball while juggling and doing financial modeling. And kind of the forward visibility was extremely limited. Kind of even the discipline or the muscle of asking kind of what's coming beyond the next quarter, beyond the next 4 quarters, no multi-year planning. So I think just building that discipline was going to it was very quickly a priority. And then just adapting everybody to kind of asking about what's coming tomorrow so that we can plan better for it, instead of kind of just hit this quarter. And they were also in the middle of a transition. They were probably farther along in it than I was even aware when I first arrived, but they were definitely transitioning from a product-led growth company to more of a sales-led growth company. And we could even internally probably still debate at Segment the extent to which, that fulcrum had been pivoting. But I think that really changed a lot of how they needed to think about resourcing, inbound funnel versus outbound lead gen versus sales intensity. And so how were then the metrics going to start to transition? How would sales cycles elongate? What would ASPs do? Again, being thoughtful about that, or trying to predict what that would all mean wasn't a part of kind of our muscle yet. We were sort of surprised when things happened. Deals were taking longer to close. Oh, why is that happening? Like just that kind of. So I would say those are kind of the 2 areas that I immediately spent time on quickly, and that included helping the sales leader start to build up a more rigorous rep ops team. If we were going to have all these sales reps running around, we needed to actually track productivity. And so anyway, those are a couple of the first 2 areas that took maybe the first 6 to 12 months of elbow grease.
So you didn't do it overnight.
Oh my God. Right. I mean, what a journey, right? Just, everything's a journey.
So you got a plan for it. So kind of in that same vein, did you have an agreement with the CEO board about thinking through, hey, we're bringing on Sandy, we want to go public in a couple of years? Was that kind of in the discussion as you interviewed for the position?
Yes, absolutely. And part of when I was interviewing, Twilio was a few years beyond their IPO at that point, was doing quite well, which was great. But that kind of background, they had definitely wanted somebody who'd been through an IPO. And so here I am now on the other side of this acquisition, and it was a hugely successful acquisition. And it's a ton of fun to be back with the Twilio crew, and super impressive to see them grow. Sort of like seeing a niece or nephew. You go like 2 years without seeing them, and all of a sudden they've like sprouted up 1.5 feet because they've been eating their green beans. And I mean, I feel like that is such a sweet ability to see Twilio 2.5 years later and just see the step function of growth and complexity. But yeah, it's a little bit sad not to have gone through the IPO again and like do the standalone thing. But no, they were absolutely committed to scaling, to aggressive growth, to best in class SaaS metrics. And very much wanted that rigor put into the business. So super supportive of come in, tell us what we need to do. Let's figure it out. Let's add the discipline. Let's add the predictability. Let's start becoming more of inspecting our performance to make sure that we can get it to that level of predictability. And so, of course, it was just as invigorating. Like there was sort of no difference up until like and we can talk about that later, but just how quickly the company pivoted into an M&A situation. I think it was faster than I could have ever possibly imagined. But up until that point, it was absolutely, build a strong company, as Steve said earlier in the call. Let's build a sustainable company. And that's going to take years to do. And so how much progress should we expect to make every year? Let's be thoughtful about that. How much investment should we put in? How efficient on OpEx should we be? All of that was very much part of the discipline that we wanted to build into the company, and ultimately served us well when the M&A situation came around, because we had more of our ducks in a row, we were already 606
Right.
compliant, et cetera. So
I think what you said there is key, is that, you know, as the CFO or head of finance in a lot of these organizations, you have to think 12, 18, 24 months out, and where do you want to be? And so it's almost the Wayne Gretzky, you know, skate to where the puck's going to be versus where it is. And you as a leader, you have to really think about where you're going to be and what, you know, people you need in place, what processes you need to have, what systems you need to implement, all that. So Jacob, over to you. Did you have an agreement with the CEO or board about taking the company public? I think you joined in May 2018. So, you know, 2.5 years later, you went public. But did you have, you know, an understanding? Did you openly discuss that in the interview? And then also maybe to the same question that Sandy had, like, was there one or two things that was really evident that needed to be fixed when you came into the organization?
Yeah, Rob, frankly, I did not have any agreement with the CEO or the board about going public. Obviously, prior to joining, I did my due diligence about the company.
Right.
And I believed in the mission and the vision of the company. I knew that the company is playing in a fast developing market, and all data points indicated that there could be public story here. But I knew that it's going to be a long and uncertain road to the IPO, if at all.
Right.
And after joining, the things that I kind of jumped at me right away was the company was very efficient, growing very fast. Actually, the company had more cash on the balance sheet that they raised, but it kept very low profile. And it was a very technical story in the DevOps space, very technical story. And I knew that it will take time to educate investors, public, as well as sometimes VCs as well, about what we do, what's the value proposition, and why we're going to succeed. Because we're category creators, no one did what we do before us. So you don't have any kind of comparisons to do. So, and that's what I started doing, because it does take time. Education does take time. And obviously, as Sandy noted, building all of those processes to scale to become a large company, not thinking about IPO, but just to become a successful company going forward, all of those sales metrics, predictability of the business, and building the systems to allow that scale and growth.
Great, great. And when you arrived at JFROG, I think it was around 60 million in revenue, around about that. What impressed you at that time about the finance function itself? If anything.
First of all, what impressed me, it was very young team, really super young team, working very hard, very passionate about what they do. So it was really fun to join the team. But what I liked was the level they supported the business with the analytics, timely management report, not necessarily closing months or quarter on time, but providing business those insights that helped the leaders navigate the company. That was super impressive. And the other thing that I liked was that they selected right systems as a foundation, laid out the right foundation for systems. Yes, we had to improve implementation, we had to augment some things, but at least the decisions were made properly as a foundation for the future build out. And those systems actually serving us today as we're a public company.
That's great. That's really important. And just kind of on that note, when did you guys decide, like, were you approached by any M&A folks? I know in this world today, we could talk about SPACs, but we're not going to do that. But were you, 6 months, a year before the company, just like, how did you decide to go public? Was it something that the board brought up, that you encouraged, that you guys felt you were ready? Like, kind of maybe walk through that.
I think it's naturally evolving process. It's not that one day we all gather together and say, hey, we're going public. There are different aspects that you constantly looking at. It's what's your predictability of business, what's your structure of the management team and the mid-management level, how scalable your processes, what the market is doing, what are the competitors doing, and your peers in this industry. And so it's evolving process. No, we viewed IPO as a yet another milestone in the company life, because obviously IPO to know, we did not think about it as an exit. It yet another step that we have to take in order to grow to become large company, and IPO obviously presents different opportunities. And that's the way we thought about it, and that's the way we approached about it.
Got it. Got it. I do see some Q&A coming in. I do encourage you actually to put a question into either Jacob or Sandy. And what we're going to mainly do is get to them in the last 15 minutes. But if you have a question, please feel free to go ahead and type it in, and we'll get around to it. And if you do it in the chat, that's fine too. We'll see it. But kind of, Sandy, going back to you, did you guys, it sounds like when you said the process was pretty fast in terms of the M&A with Twilio, had you thought about going public prior to that? Like what was the decision process around that, like M&A versus IPO?
Yeah, and I guess I don't want to overstate sort of when you would ask like, hey, was there an agreement to go public? I think hearing the way Jacob framed it, I think is probably more similar to, I think, the way Segment was thinking about it, right? That's probably, if you are building a sustainable, healthy business, if it's growing at the right rate and pace, as our investors and board members believe that it could, that would be probably a very likely outcome, and that we needed to be preparing for it. And so I would say there was very much in that ongoing dialogue you have with your investors, and I can't say enough good things. You asked Jacob, like, what were some really strong things that he found at JFROG when he got there? There were similar strengths at Segment in the sense that their board and their investor group was very strong. And that was one of those signals that I looked at when I was initially talking to them. But then the board conversations were super thoughtful, a huge learning environment, a growth mindset environment, very thoughtful community in the boardroom. And then as we would think about the next investor group, we very much wanted that next investor group to add to that conversation and to round out the advisors that we had. And at some point we realized we wanted another go-to-market advisor, and we wanted more scaling and growth expertise. We wanted people that had connections into industry and to some bigger enterprise connections. So that very much thinking about how they evolved, the boardroom was helping us think about the investors that we wanted to be in touch with. And then the scale that we were starting to operate, we started to think about crossover funds, and should the next round include some crossover funds so that we could kind of learn how to think about talking to public investors and not sharing as much, but still getting the narrative across. So I think all of those things were well underway. And we spent time on building those relationships so that ultimately by the time the M&A conversation came up, we did have a lot of, whether it was pitch decks or multi-year plans that had rigor to them. And so by the time the diligence team we engaged a banker, and by the time they said, send us your multi-year model, it was a model that thankfully had sort of been stress tested a bit, that wasn't crazy wonky. And so we could move pretty quickly with that multi-year model to add a couple more years onto the end to get it to be a 5-year view instead of 3. And so all of that stuff enormously helpful that we had kind of more at the ready, which if we are not kind of trying to grow up very quickly to be eventually theoretically public, it served us incredibly well in M&A. And all the public company accounting standards that we were already adopting, I am enormously grateful for those, because having been on the other side of some acquisitions where you're trying to acquire companies, private companies that had not yet gone through all the GAAP compliance, that creates so much noise in an acquisition, so much noise on valuation, where the buyer can't really understand how the P&L is going to ripple through into a GAAP presentation. And that makes the multiples all wonky. And so just incredibly grateful that when I did walk into Segment, we had a really strong accounting team. I would say, well, we didn't really have FP&A built up yet. We had an incredibly strong blended accounting team. When I say blended, we had very strong technicians and operating accountants, all kind of molded into every role. You were expected to know your policies and know your memos, but also know how to interact with sales, get a deal done for RevRec, et cetera. We expected both of a team as it was forming, and enormously grateful for that rigor. And I saw a question about systems. They were already on NetSuite, thankfully. I agree with Jacob, like there were already some really good systems in place. that, we didn't have to deal with a QuickBooks migration. It had already been done 2 years earlier, just thankfully.
Right. I would say that from a system standpoint, let's say your public or M&A date is X. I would say you subtract probably 3 to 4 years, and then that's when you should implement a system like a NetSuite or an Oracle or SAP or Workday or a robust ERP system that will help you through all of this. And so if you're thinking right now about an IPO or potential M&A in the next 2 years and you're on QuickBooks, I would say that you're late to the game and you need to get on it. I will tell the story of, I have a friend who went public on QuickBooks. So it can be done. That following year, he spent most of his life putting together NetSuite into the system as a system, but it can be done. But it was very painful, and he regretted not doing it earlier. So anyway, so any fun story from the M&A process, Sandy, that you want to share on our small little group here? That won't
Yeah,
get
small little group. I would just say that it was so surreal to be in conversations with prior colleagues. And I would say that the going through diligence with George, who on the other side was quite intimidating. I had gotten to work with George for a couple of years before I left Twilio. Yeah, George, who is the COO of Twilio, and he is super, super impressive. He is so smart. It was intimidating to work with him when I worked with him at Twilio. And just the rigor that he brought to Twilio when he joined, it just was such a massive step function. And at the time I was the VP of finance at Twilio, and I think the first thing he said at Twilio when he walked in the door was like, okay, it's great you have a budget and everything, folks, but I need 50 more sales heads tomorrow. Let's figure it out. He just would he just step function changed things. We got to think big, we got to go for growth. And just the way he attacks things, at a strategic level, he really wants to go do big things, and it's exciting. But he can go to the lowest level of granularity, and he'll look at a slide for 2 seconds. He's one of those guys who's just so smart. We'll look at a slide for 2 seconds, and we'll pick out the one small, tiniest little decimal anomaly that's the quirky. What happened in April of 2017? And you're like, yeah, okay, that's right. That was the month in which we had a customer transition or the renewal. Anyway, so just preparing for diligence with George, I think, was one of my more intense, homework study periods where I knew I had to really have all of my Q&A lined up. And then, of course, he said, this is great. At the end of it, he's like, this is great. Let's do another hour tomorrow.
Oh my God.
And I was like, oh God. And then on the next day, he said in another hour the next day. I was just, oh God. So anyway, but we got through it. And that was probably more on a personal side for me, just having worked with those guys before.
Yeah, no, that's great. And kind of Jacob, on your end, is it any kind of fun story, or as you decided to go public, the public process, or anything like that? I mean, given we're in COVID, maybe it was
that's
why I did it.
What I had in mind, actually, because we kicked off the process early December 2019, filed preliminary S1 in February, had this analyst teach-in early March, actually March 8th, I think. And then the next week, everything shut down, right? And the next step is analyst modeling session. And everyone is pulling out guidance. Public companies, established public companies, don't even guide for the next quarter. And how do I provide my plan for the next 3 years, right? when the world falls apart. So that was the moment when we decided that we really need to take a break from the process and to see where the world is going to. So we continued kind of SEC route, kind of on a slow burner, responding to the SEC comments and kind of going back and forth with them, but actually stopped the process until end of June, when we kind of started seeing kind of light at the end of the tunnel. Some companies started coming back to the market. Then we saw this opportunity to go out early September, and then we accelerated the process toward that.
Awesome. Did you, given what you know today, is there any advice that you would have given yourself a year or two ago that would have really helped you along this process?
I think this process, every CFO is waiting for this process. And kind of in retrospect, I probably should have been more relaxed, kind of enjoy the process as we go. But, going through pandemic and different challenges, how do you keep your team healthy? I had one person on my team got COVID. So, having someone out for several weeks could extremely jeopardize the success of the process. So those were the kind of challenges that I had to deal with. In that respect, I guess it was fun, but back then I should have been more relaxed.
Right. Hopefully that team member's okay. What about you, Sandy? Any advice that you'd give yourself, a year or two before the acquisition happened, that you wish you would have done differently or better or been more prepared for George's questions?
I mean, oh, I know, right? I think in terms of like the preparedness, I think we always want to be more prepared than we are. Like, I don't know that that's really advice that I don't know how much I could do that differently, in the sense of like, do I wish that we had a 5-year model instead of a 3-year model? Of course. Do I wish that we had, really more data points and more trend lines on commercial productivity trends versus some enterprise productivity trends? Do we have a stable definition of enterprise that hasn't changed every 6 months? Not quite. But how pragmatic can we be about really achieving all of those things in a fast-paced startup? I think we did the best we could. And so I feel pretty good about, I think, where we focused on 12 months out, if you will, or 18 months out. But I think the advice I would give myself is in the moment where the acquisition started to become a possibility, I think I was like a deer in headlights for a little bit too long of really not believing that this was where we were going to go. I was kind of going through the motions in the beginning, like, okay, we can get a diligence pack together. We can get the management deck together. We'll talk to Catalyst. Well, it'll be a market check. Okay. But I think I was still a bit incredulous. And so I think advice for myself would be to really kind of pivot quickly and embrace it in the way of trying to think more quickly how it can really be an optimization for the company. I think it took me a little bit too long to think about why it might not be the exit that would be the best exit, rather than glass half full.
Yeah.
Why is this the best exit? And so ultimately, when we think about the employees and their careers and the acceleration of the combination, the acceleration of some of the best practices, and then ultimately the joint product stuff, which we didn't get into early in sort of the M&A discussion, you really get into that after the close. That's when the joint product vision becomes like super exciting, and you can really get into like the transformational opportunity. And then, so I think in hindsight, in the beginning, I think I wasn't as open as I should have been to seeing how good it could be for Segment as a company, and then ultimately for the joint companies. Right. And for the employees. I mean, I think the careers of the segmenters, I think, are going to get catapulted in this overnight business combination. They're getting the luxury overnight of seeing a much more mature company at Twilio. They have more mature processes. They're more global. They have distributed engineering in countries around the world. I mean, they just have skills and capabilities and reporting and visibility that is off the charts to what, of course, we wanted to build. But getting that immediately is just amazing. Smart, talented, young startup people, they copy that stuff really fast. Like it's like we have a big mentor all of a sudden, and every employee can just kind of step function up. So that's already been fun to see.
Your inability to see the good is a common CFO trait, which is in some sense a good thing, because we want to see risk behind every corner, and we want to plan for that and prevent that. So and a lot of M&A actually don't go forward. So you enter in discussions and it falls apart. So it's not that unusual. You did mention Catalyst, I think you said your banker. Any any thoughts around, maybe not them specifically, but engaging a banker? And
Oh my God, it was so helpful. Oh my gosh, it was
I mean, I
this.
know those guys are really good. So
Oh, and they were great. So not to make it an advertisement for them, but they were great. They were salt of the earth. They were so hardworking. They were calm. They were measured. They had great process and procedure. They do this stuff all the time. So just in terms of like knowing market rates, market trends, and negotiating points, such a good advisor. But I would say, regardless, of sort of who you wind up working with, having a third party advisor is so helpful. It's such a great mediator amongst the board and with the board. Our board, again, as I mentioned before, happened to be, again, not happen. Obviously, the founders did a lot to make that configuration, but they already were really collegial, really worked well together. But they were also really explicit about they might have a different perspective, and how were they going to value an exit, not just on dollars, but what were going to be the soft attributes of an exit that were going to be important to each of them. And certainly employees and career were a piece of it, but just having a banker be in the middle of all of that instead of like just the CFO really helped organize those conversations so they could be really productive, and keep kind of the trade-offs explicit. And they brought a cadence to the whole journey. And we did also some things internally that we had two independent board members who had joined in the past 12 months. And one of them very quickly kind of took the lead seat, declared that we needed an M&A committee, had a 3-person M&A committee, and declared that we were going to meet quite often. We were going to meet 3 times a week, which seemed a little crazy, but 30 minutes. And she's like, look, if we don't need the meeting, we'll just cancel it. And that she really forced us to have this constant pacing. And sometimes we'd only get on the phone for 15 minutes, but it's so fluid that I think her kind of forcing us to have this just constant touch points.
I think that's great. I've been involved in a number of these, and I think having a process around it, especially for the board, so that and also a subcommittee, so you don't have to get the board together all the time, so that you don't have to coordinate a million people's calendars is really helpful. Jacob, going kind of discussing the IPO process, how did you decide on a banker? And then were you at all entertaining any M&A process, as you led up to the IPO, or was that not even a consideration?
No, M&A was not even a consideration for us. And in the banking selection process, what is important for us is the teamwork and partnership between the banks. We all know that there could be a lot of ego in the room sometime, and we selected those that really open to work together with other banks, and I think it worked very well, and they're all very supportive, and I'm thankful to them for the great work they did. Although we did have some bank that we agreed on economics, and just 2 days prior to filing the draft registration statement, they come to me and say, hey, we know we agreed on economics and we're fine with that, but we cannot be to the right of that other bank.
Wow.
You either have to change our economics, or we cannot be on the syndicate. So we had to part ways, and
oh, you did?
Yes,
I think that's great. I think it's great that you told them to goodbye.
And then they came back, but it was too late, and the train had left the station. But there, we tried to build a syndicate in a way that all of them work together, all supportive of each other, and kind of put the egos, behind the doors when they enter the room.
Right. Did you know the bankers prior to, like the bankers you ended up selecting? Did you know them prior to the process? In your other dealings, other companies, or was this kind of first time?
I obviously worked with the banks in my prior companies, but these specific bankers were new to me. I'm coming to JFROG from hardware semiconductor world, and it's different bankers. So software was new to me, and these specific individuals created relationship with the company even prior to me joining the company. And they knew the business, they knew the culture of the company, the goals of the company, And that's obviously we conducted a selection process and decided on the best banks. And one of the key requirements for them was, guys, you have to work together.
Yeah, yeah.
And
Sometimes
just
banks. Sorry.
I'll just jump in on the banker point. You know, here at Sapphire, and we love our friends at Goldman and Morgan Stanley. They do great work on IPOs, and they have very, very high market share. But we, as I said up front, you know, there's, as Jacob says, there's sort of a place for everyone. There's other major bracket banks, you know, the BMOs, the RBCs, you know, Wells Fargo's, you know, people who don't have as big a brand in Wall Street, but who add some value. And then there's the boutiques, the JMPs, the key banks, you know, they sort of all have a role to play in the process. So we get, if you ask them the right questions and use them the right way, you can get a lot of value out of bankers.
Yeah, you know, I think it's important to communicate with banks that they have to play nice with each other, especially in an IPO situation. The thing that I would encourage the folks on the webinar is to meet some, if you don't know bankers, I would encourage you to meet some bankers and just get to know some of them, whether it be at Goldman and Morgan or KeyBank or JP Morgan or whoever, Citi, you know, make sure that you're plugged into that network. And while this may make Steve unhappy in me saying this, remember that bankers are brokerages of information. And so whatever you tell them can get spread. So just be super careful about how you're communicating to them so that they don't take that information and effectively use it against you. Not that they necessarily would, but again, they're brokers of information. So they're using that information all the time.
Yeah. Well, as a former banker, my excuse me, my son once asked me what I did as a banker, and I said my goal is to be a smart and discreet carrier of information. That's sort of my main goal. Yeah.
Some don't always apply to discreet. So I'm going to flip it over. I'm going to go to some of the Q&A that's been building up. So if you have a question and want to ask it, there's a Q&A box on the lower right side of your screen. You can click on that and we can answer some questions. So this is at Jacob. What were the key foundational systems in place that you were appreciated when you came on? So it sounds like, Sandy, you had NetSuite already implemented for you. So Jacob, what?
Yes, NetSuite, Zuora, and Salesforce. That three systems, the kind of backbone of, I think, every SaaS and subscription-based company. And we had them in place already. Okay,
great. And a kind of a jump ball here. Any thoughts on corporate treasury holding Bitcoin? I will weigh in and say no. Especially if you're a private company. That's in my opinion, a big mistake. So the CFO that was prior to me at Move, which was a public company, got fired because he invested in auction rate securities and they turned illiquid back in 2009. And he was fired for that because he was told that he should get out of those investments. So, you know, I would highly recommend your job as a CFO is to manage risks. And it's a really easy way to throw your job down the toilet, in my opinion. I know that Elon Musk is a different breed and more risky than I am CFO. He's a founder. And he got, I guess, Tesla to buy 1.5 billion Bitcoin. Great for them. You're not Tesla. So, but Sandy and Jacob, any thoughts on that?
I absolutely agree. The CFO role is to manage risk and liquidity, and you don't want to add more risk. You have enough risk in your life. Anyway.
Ditto to both of you. Absolutely.
Sandy, this kind of, I think this came into connection with you were providing some forecasting to the M&A process, and you had 3 year and you moved it out to 5 year. What was the confidence did you have in your forecasting current year versus the next year versus the out years? So let's say you're in, you know, March and you're forecasting the rest of this year and then the next year and the following years. How did you think about that?
We weren't, I don't know that we were asked explicitly about years 2 and 3, but I think there was a lot of talk about sort of near term versus long term in more vague terms. I would say COVID weighed heavily in terms of the certainty on this year's forecast. We had adjusted our forecast in early COVID days in sort of March of last year. And as the year progressed, we, like many other tech companies, found much more confidence that I think what we thought was going to potentially be a massive downward spiral turned into be more stable and potentially even more opportunistic for some technologies. And I think we found ourselves in that boat. So we were sitting in a situation where our adjusted plan, while we had to take it down a bit in March, we were quite confident that we were going to wind up being able to hit the current year. But it wasn't quite the growth rate we had ideally wanted. It was sort of a COVID adjusted growth rate. And then we had acceleration coming off of that. And so there was a lot more discussion sort of thematically around whether or not and how we were going to be able to accelerate and what pieces of the revenue line were going to really drive that. And so the enterprise commercial debate was a very explicit one. And the trends in our commercial business were more steady and long enduring, versus enterprise had great successes, but it was sort of the classic early lumpiness of enterprise. We sort of had some big ups and then some downs, sort of like, hey, is this really going to stable? Like, are you really going to, when is the consistency going to come into this enterprise line? So it was a lot more, I think, discussion about the granularity within that top line number of where there was a different level of confidence in one part of it and sort of a more like, we're not sure when the stabilization is, but we know it's up and to the right, but
how much?
The slope of that, we're going to debate, and then the investment it's going to take to get us there and how product ready we are in the enterprise. So I would say the enterprise was just a more kind of opportunistic conversation.
That's totally fair.
Yeah.
The way I kind of think about it is like the current year should be, your confidence in the current year should be kind of 80 to 90%. The next year should be anywhere from 60 to 80%. And after the second year, it's kind of a thumb waggle. I mean, if you're 25% right, fantastic. You are predicting the future and you should go trade stock. So it gets a lot more wonky. Now, from a modeling perspective, you should have some definite, thoughts around your assumptions and backup. But after you go beyond 2 years, I think it gets really dicey. And any M&A process, the acquirer is basically going to discount anything that you put forward for years, definitely years 3, 4, 5, or beyond, because they know that it's a crapshoot that won't probably hold water. And this is to Jacob. Are there any specific roles like SEC reporting, tax, technical accounting, et cetera, that you didn't have that you specifically hired on your IPO readiness path? And if so, what was the timing of those hires?
Yes, obviously, as the private company, we used to report our quarterly financials to our investors, but the level of those financials versus PCAOB based is kind of huge difference. As a private company, you never pay attention to issues like stock compensation, like tax. You're primarily focusing on revenue. So we definitely invested initially a lot into automation of the revenue related processes because revenue is a high risk. And as we continued on the path to the IPO, we actually used external advisors for tax and stock compensation. Well, later on, we brought stock administrator in-house because we had to implement stock administration system, and typically you do all of those 409As backwards and revise your stock compensation years back. So we really needed that function in-house. But till today, we don't have anyone dedicated for tax in-house with external consultants. We just recently brought.
Are you profitable?
On a non-GAAP basis.
Okay, so not profitable on a financial basis, which means that you're doing a full value.
Still carry valuation allowance, but there's still some uniqueness in the tax accounting. We just recently brought SEC after we went public. We brought SEC in-house. We used external. So really combination of in-house and external consultants. That's the path we chose.
Yeah. My general recommendation usually is you should bring on at least like a tax manager a year before a year before going public. And that's only because it's someone to coordinate with the outside advisors to, sales tax and use tax and payroll tax and all that stuff, but also like your financial footnote, your tax, just to have somebody coordinate it with both external people, but also the auditors. I recommend that. Stock administrator, I recommend at least 6 months before you go public.
Right.
SEC reporting, like we brought in someone external and then we kind of trained up our people and we left it, or what we ended up doing is use it as a carrot to people that were internally within the accounting function that, hey, if anyone is interested in this job after, a year or so of being at the company, you can basically learn from this outside external person and then take it over. And that's what we ended up doing, which I thought was great from a promotion and path standpoint. And then one thing that people oftentimes forget is an audit committee. You need to have an audit committee when you go public. And so I would highly recommend to bring in that, chair of the audit committee at least 6 months, if not a year prior to going public. And you got to get to know that person. And that process might take 6 months. So it's really 18 months. You almost have to start. We brought in Diane Irvine, a week before we filed our S1. So at Yelp, which she, I guess, trusted me. And so it was it was smooth sailing, but it was a bit crazy. So Sandy, I see one here from you. Do you think that your previous time at Twilio provided additional value, understanding both companies very well from working with them to the M&A process?
Absolutely. It was, so surreal. I still can't believe it's happened. But so surreal to wind up being sort of on the other side of the table in a negotiation with your prior employer. But ultimately we knew each other very well. And I think there was trust. They knew, you take yourself to work every day. I worked with those people for 5 years. They know exactly what they were going to get with me, the good, the bad, the ugly. And they knew what they could rely on me for. So the trust there, I think, was very deep. And also, I think having known Twilio, again, when I finally got my head wrapped around, this is where this is all going to go. Twilio is always passionate about the joint product vision. That's how I knew Segment, was hearing Twilio speak very highly of the technology and being very interested in the aggregated unification of data that Segment was able to offer its customers, and how that could be combined with Twilio's communication and outreach to contextualize a customer engagement so that it could be even richer. It was a long told story inside of Twilio in the sense of absolutely matching with Jeff Lawson's product vision and his excitement about customer engagement and always wanting to bring things to the next level to make customers ever more delighted and customers of our customers ever more delighted. So the product narrative there was just so clear, and that joint vision being kind of the underpinning of what this transaction was really going to be about. It was a much longer term vision, was great.
Awesome. So one of the questions is, how far out from IPO should a company start participating in private company investor conferences? Seems there's a balance in building relationships, trust early, but also being protective of time. I'll take that one, and then if you guys want to jump in, I would say 2 to 3 years. The first thing is to try to get invited to these. Sometimes it's tough to get invited to them, but hearing what the feedback is from the market, from the investors, is actually really pretty critical to shaping your story. So to the extent that you can, maybe it's just 1 a year, maybe 2, but I would try to get in 2 to 3 years prior to kind of the kicking off the process. I don't know if you guys have any thoughts or.
I absolutely agree with you, Rob.
Yeah.
That's the time frame. You don't have to do it on a quarterly basis. You could do it once or twice a year, but getting that feedback is very important. From the moment the pitch that we started with and the pitch that we ended up with is completely different. And also, it's typically you don't want the first time to see investors on your roadshow or even TTW. You want to know those investors prior to that. So and it takes time, and also meeting analysts that cover in your industry in order for you to be able to select later on the syndicate appropriately. That's also very important.
Excellent. Yeah, totally agree. And then just this maybe last one, because I think we're running out of time. How far out? Let's see. No, sorry. Great that you think. Oh, what are some of the key things you were thinking about with regards to your employee base as you went through the IPO M&A transitions? Any?
I'll go quickly and say career path, career opportunity, career acceleration, and a joint opportunity from our side. Jacob.
I absolutely agree, and it's critical to bring talent into your company so they can help you to take you through this process. Because, as I said, we were a very young team, and we had to bring experienced leaders in the finance organization to help us to scale and bring to those levels required.
Yeah,
level.
yeah, agreed. And the other thing I would throw out there is liquidity. It's nice to provide employees who've worked long and hard a nice little savings account as a cash in the stock. So anyway, encourage that as well. I think, Steve, we're out of time, so I want to turn it back over to you, but thank you for hosting us. Thank you to Jacob and Sandy for giving of their time and their mind share to help other CFOs be successful in either an IPO or an M&A.
Thank you. Rob, did you want to give anyone any do you have any ongoing CFO network activities or anything like that that you want to promote?
Yeah, the only thing I'd say is friend me on LinkedIn, or I don't know what the correct term is, link me on LinkedIn, and then send me a note and say if you want to be put on the list to go to the class. Unfortunately, given COVID, we had to not have the class, and it's an in-person class. I do teach at Wharton one day a semester, which has been canceled, but hopefully we'll do it in the fall. And then I do it with some VCs, including Sapphire and some others, where you can come and participate. So friend me or send Steve a note that you'd be interested in participating. I'm happy to include you. My goal is to give all my scar tissue and expose it and help the next generation of CFOs become a lot better than I was. So thanks, Steve.
Thanks all for joining. Really appreciate your insights. And for those on the call, if you have any other questions, you can go through me on LinkedIn or Steve at sapphireventures.com.
Great. Thanks.
Great. Thank you all. Thanks, Rob. Thanks, Steve.
Okay.
Yeah.
Nice to see you,
Bye.
Jacob. Bye, all.